Hi, it's good to be back up here, and it's been a great session so far. Greatly enjoyed it. I thought it was very interesting that Professor Stopford highlighted the ability of the Greek shipping community to identify profitable opportunities. And I also thought it was interesting that Mr. Platzidakis highlighted their enthusiasm for standing on their own feet, doing their own thing. They don't need subsidy. But then Dr. Drobets mentioned that they were in a very risky area, but fortunately there is an ideal risk mitigation tool. So I'll now talk about that. So I think the Duncan, who works for SSY Futures, is probably a little bit more aggressive in his marketing than the Duncan Dunn of the Baltic Exchange. So since we're going to talk about FFAs, I think it's interesting to note that the futures business at Simpson, Spence & Young has around 30 brokers, and they are in the very core of what we do, totally integrated in our business, particularly on the dry cargo side. And since we've been in this market, we've also successfully diversified into iron ore derivatives, which are of great interest to many of our customers. And we've recently been voted the best iron ore broker. And we're also the leading broker in coking coal futures. But let's focus on the FFA side of things. Forward freight agreements, contracts for differences. It's like a bet between two people. One person thinks the market's going up, one person thinks the market's going down. We use systems from the financial markets to ensure performance, and we'll look at that more later. But in essence, what this is a financial instrument which enables people to take a position on the direction of freight rates. So how much you use it? Well, from a time charter perspective, if you had fixed a low rate for a number of years and you saw the markets going up, you could buy FFAs, and that would change your net position into a floating rate from a fixed one. Quite a speculative strategy. You're going from security into a floating market. Alternatively, if you'd fixed and left your vessel on short term, then you saw the market turning and maybe going to fall from a higher rate to something less profitable, then you could sell FFAs, and that turns your net position into a fixed one. That's very risk averse. Both solutions come from FFAs. If you want a little bit more risk, you want to mitigate your risk. And then there's the pragmatic approach available to someone with a floating rate time charter and a long-term relationship with a miner, say. And they might, both sides will enjoy a long-term relationship. The market rate will float, but when the market rate is high, the owner can, of course, sell FFAs and effectively fix his earnings, but without impacting on the charterer's position at all. Or, of course, increasingly people use FFAs as an investment tool. Now, it's interesting that over the last 15 years that I've been coming down to Athens, a lot of people have said, you won't find many takers for FFAs amongst the Greek ship-owning community. They're very, very conservative. They've been in their business for many generations. But in actual fact, some of the most effective users of FFAs come from the top end of the Greek shipping community. Some of the most effective risk takers do as well. And so we see people in Athens who hold ships and use an FFA strategy to control their risk exposure. But we're also interested in the fact that people who have portfolios built of shares in listed companies can use FFAs on occasion to hedge those, or alternatively, to enhance their return by selling options against them. And then, of course, there are those people who want to gain exposure to the freight market but choose to use an expert fund manager. And of course, the hedge fund business, as has been highlighted very recently, are increasingly turning to the forward freight agreement market to gain exposure. And now we have some new opportunities coming out. Pretty soon we're expecting to see exchange-traded funds where you'll be able to buy shares on exchange-listed companies who use a portfolio of FFAs to give their customers exposure to the market. Tradable indices are also in the pipeline. And of course, there's been a great deal of publicity recently surrounding the removal of the handy size from the Baltic Dry Index. Those handy indices are incredibly important to our business. They're important to the Baltic Exchange, they're important to the market. They continue to be at the heart of the market. But in the forward freight agreement market, they've not been tradable. So removing the handy component of the Baltic Dry Index will make it easier to release a tradable Baltic Dry Index, and that's another exciting opportunity. Exciting for the FFA market as well, because of course people who offer an index position to their customers in the BDI will in turn offset their risk by trading FFAs. So all these things moving in the right direction. And finally, structured products. There's been evidence of structured products on the freight market in the past. Not so many around now, but we have a lot of interest from a number of financial services companies who are looking to make these available too in the future. And again, they will be constructed using FFAs. So FFAs really are already a fact of life in this market and used in a great many different structures and strategies. The forward freight agreement market has settled against Baltic indices. And generally speaking, there are two types. There are the dollars per day time charter indices and the dollars per metric ton voyage indices. Most FFAs, if not all of them, are priced against the time charters. And we use Baltic standard vessel descriptions, so you can take out an FFA on a standard Baltic size Cape or Panamax or Supramax, and from time to time these are updated and their specifications are modernized and so forth. And of course we have changes coming soon, the Panamax moving to a TES 82. We're in the throes of replacing the 52,000 metric ton Supramax with a 58, and the handysize going to an Imabari 38. So interesting developments there. One of the busiest FFA contracts is the Cape-size time charter average. So I thought I'd just put the component routes for that up here. Effectively, if you have exposure to the Cape-size market, then there will be very close correlation between your individual trade and the Cape time charter average forward freight agreement. And that is why the time charter averages are the instrument of choice, really, for FFA traders in the dry market. Very straightforwardly, we transact against a specific period in time, and in this instance, we have the example of someone looking at a Q2 Cape-size time charter average contract, and they've decided to fix at a rate of $14,000 a day. Both buyer and seller fix at that rate. And as you can see from the example, if at the end of April the market settles at 15,000, then the buyer has profited by 1,000 a day. You can choose how many days exposure you want. Usually it goes in fives, but you can trade as little as 5 days for a single month in an FFA, or you can trade all the days in the year. You can tailor an FFA to get the exposure that you desire. And FFAs will either settle against the average of the Baltic indices quoted during the month, or you can sell them along the way. You can buy and sell FFAs according to the market price along the way. And we use the clearing system, so an FFA nowadays, although traded in an over-the-counter style where you'll talk to a broker who'll match buyer and seller, following execution, the broker will input the trade details through a central clearing counterparty. The positions go to the clearing brokers where each side hold their accounts, and the resulting position is listed on exchange. So this is a secure way of dealing. And again, referring to Dr. Drobets, this is an area where you can be certain of your counterparty position because there is an exchange standing behind your dealings, and you can look in some detail at the finances of the clearing broker you choose, whether that's, say, Macquarie Bank or JP Morgan or any of the other many financial brokers and banks who support the freight clearing service. For clearing, you have to put up a deposit. And in this instance, I've listed those used by the Singapore Exchange currently. You can see that there's a 3,300 per day deposit required currently for a Cape time charter average. But in fact, as you move forward along the curve, that is generally discounted. So in this example, we see $1,430 per day. And so on a Q4 contract based on 10 days per month, there's only a need for around $43,000 to secure that position. So if you look into a full year's exposure on a Cape, the maths comes out at around $500,000 exposure. Of course, you're mark to market at the end of each day, so you may see substantial P&L on that, and it is important to understand the cash flow implications. So, this is the position at the beginning of this year in terms of pricing of the Cape time charter average. And you can see that the market had enjoyed a good period at the end of 2017, and the price had been as high as $30,000 a day. It's a shame that extra naught's not there, but there we are. The market had been taken into one of those positions where hopefully Dr. Drobets' negative return was actually replaced by a period of profitability. And you can see at the time where the red line forward freight agreement rates were priced. So they were at a discount. And now you can see where they are, or where they were last Friday when I lifted these prices from one of our reports. And you see that although the FFA, although the Cape rate has actually fallen, and it's fluctuating between 10 and 15,000 a day, the forward rates have actually gone up. And that's because they're two different instruments. One, the spot price, and the other is the rate where people believe they should be transacting in forward freight agreements, where the buyers and sellers are colliding. So that's quite an interesting illustration for a pragmatist. There are moments when the FFA market is affording very advantageous pricing. And although in a higher market we usually see a discount priced in, so there's a very favorable opportunity for a charter wanting to hedge, from time to time there is an extremely good opportunity for owners wanting to lock in a favorable rate. And now another illustration, and this is the same for the Panamax market, and the orange line was the forward pricing on the 16th of February 2017. The more turquoisey line above, I'm not sure if I've got no, I don't think I've got a pointer. So that was 2017 pricing. and that in 2018. What's interesting is if you look at the red line, and that is the second-hand value, the Baltic's 5-year assessment for a Panamax. So you see that the underlying physical vessel's price and the spot earnings are correlated quite interestingly, and there is also an opportunity in there where the current pricing on the forward curve is showing some advantage. So how do the volumes look? Well, the market's been slow but steady over the last few years. And what we saw is there's the red line of the over-the-counter trade falling away, and the market now really being an exchange-cleared product, which is building slowly. But we see significant room for growth here. And I think the core reason for that is that the main use of the FFA market is in the Panamax, and the Cape, and the Supramax size. You can see very little activity in Handysize. But also, and this is at the heart of it, I think, if we look on the right-hand side, FFA activity by company types. So we see traders and cargo interests providing 57% of this market. Banks, funds, and finance at around 25, and I'm going to wrap any second. 18% is coming from owners and operators. Now, we expect that as the physical rates improve, there will be far more opportunity for hedging in the market. So we anticipate heightened use from the ship-owning community and operators, but also, interestingly, we expect the banks and funds to become increasingly involved in the next few years. So in terms of identifying the time to become familiar with and start to look at the FFA market, that would be now. Thank you very much.